this computer. Okay. First of all, thank everyone for joining us. I just sort of want to give a framework for what we're doing today. It is an interactive process. Uh, Dan and Brian are more than happy to take questions as we go. Uh, but if you see that they're on a roll, right, then allow them to finish that thought, whatever it may be. Uh, if you raise your hand, I'm gonna keep the my program not on the speaker view. My suggestion to you all is to put it on the speaker view because when they do the PowerPoint, you'll see the full screen. Okay. To Brian's point, I am recording this so that's available for people afterward. So it's going to be there for them. So I thought that it was important, and I want to thank Dan and Brian for being willing to do this. But I thought it was important with all this chaos going on to sort of get an understanding of where we are at this moment. Now, understand that things are literally change minute by minute right now, especially with this administration. So, a couple of rules of engagement. Raise your hand. Okay. I have my trusty notepad here. I'll put people's names down. And if you're like Blasham, I don't know who Blasham is, but I'll just say Blasham. That's what's showing up on there. I know it's Steve Campbell, but I'll say Campbell. So whatever name is on the screen, I will call you by that name that's on the screen. Um, so why don't we just go ahead and get started? This is scheduled for between 60 and 90 minutes. We probably won't take that long. That's what it's scheduled for. Let me introduce Brian Kwan. Brian is the managing director, a senior consultant of Veris Investments. Brian helps institutional investors optimize their portfolios through developing and implementing investment strategies, navigating capital markets, managing risk, and improving governance policies. He works with a diverse group of clients and covers all asset classes. He's a member of Veris's Management Committee and Alternative Investments Committee. Welcome, Brian.
Thank
Excited to
you.
have you. Dan Quilico is a consultant for Veris Investment. He consults on multiple Taft-Hartley trusts, leading client engagement across defined benefit, defined contribution, and health and welfare plans. Knowing the unique challenges that multi-employer plans face, his collaborative approach provides trustees with tailored insight and advice needed to make informed investment decisions. Thank you, Dan.
Thank
So
you, David.
you two are on.
All right, thanks, Dave. Good morning, everyone. I'll kick it off real quick and then turn it over to Dan. So today we are going to talk about all the things that are going on in the world, hopefully provide some context and insights into where things are as of this minute, and then discuss some of our outlooks. So the way we're going to lay this out is I'm going to turn over to Dan in just a minute. We're going to look at the current economic landscape. We're going to touch on a ton of different topics from tariffs to inflation, labor markets, so on and so forth. So that's kind of level setting where we are and what we're observing. Then we'll get into kind of the impact on markets, consumers, businesses, and what we're seeing there. And then we'll wrap it up with kind of our outlook in different scenarios that we see playing out and kind of some potential probabilities associated with that. As Dave mentioned, things are changing minute by minute. There were some developments that were constructive yesterday that we'll incorporate. But again, this is as of what we know today. And I think the big takeaway here is that there is a massive range of outcomes, more so today than I can remember in recent memory. So with that, I will turn it over to Dan. And the last thing I'll say is please ask questions. We want to make this time as valuable as possible for all of you. So with
All right.
that, go ahead, Dan.
All righty. Thanks, Brian, and good morning, everyone. Can everyone see the presentation? Are we good? Do I need to zoom in?
Yeah, it looks good.
Okay, we're good. Okay. All right. So, as Brian mentioned, I'm gonna cover what's currently going on in the economy. We're going to start with tariffs or trade negotiations, and rightly so, as they've really been the single biggest driver of economic outlook since the beginning of the year. Just so we're all on the same page, when a good comes from another country and enters our borders, an additional rate or tax is applied on that imported good. So that tax or additional rate is the tariff. This rate is paid by U.S. importers or the domestic business, with the revenue going to the government. So when Trump assumed office, he was very clear that he was going after countries that were deemed unfair when it came to the current trade agreements with them. Uh, at the beginning of April, as some of you may know, Trump announced a new tariff plan, which included a broad 10% tariff on all imported goods, as well as country-specific reciprocal tariffs. The reaction from markets and most economists, it was surprised. They were surprised, as the plan was largely more aggressive in magnitude, breadth, and timing than most expected. So what you see in front of you is a timeline. If you look at the bottom there around April 9th, that 90-day pause, that's somewhat where we're currently at. As David mentioned, as Brian mentioned, things are moving. So there have been some changes, but for the most part, there is a 90-day pause for most countries, with the exception of China. And it's becoming clear that China is being targeted specifically. China is our third largest trading partner. We currently have our largest trading deficit with them. So you can see why the admin would want to target them. The current trade situation with China really has negative consequences for both countries. Both countries would likely face an economic slowdown and higher costs, which would reduce consumer spending and business investment. China is one of our largest foreign investors and holders of our debt, so there could be consequences there if they start to divest. And at each country's current tariff rate on each other, we are essentially freezing trade with them, which both sides know is unsustainable in the long term. So it really is in each country's best interest to come to a new agreement that benefits both. This entire tariff situation it's very fluid, which makes it very difficult to predict, what could unfold. In fact, yesterday, Trump announced a much softer stance in regard to trade negotiations with China, and the stock market's reaction this morning has been positive. So, like I said, these things are changing by the minute. Alrighty, looking at inflation. So inflation was the big concern of the economy for the last couple of years. As you can see in the graph in front of you, at the end of 2021 and into 2022, we see that big spike in inflation, and that was primarily related to supply chain issues coming out of the COVID pandemic. Although we're starting to see inflation, come down primarily due to some much needed easing in stickier components such as shelter, for example, the uncertainty around tariffs really is the wild card here. So tariffs, as mentioned, they do increase costs for businesses and consumers. So we do think there is a little bit more risk to that upside than to the downside moving forward when it comes to inflation. All right, the labor market, it continues to be resilient or relatively strong, but we have started to see some weakness in some of the data. Unemployment has been ticking a little bit higher, as you can see over the last, call it 6 to 8 months, but by historical standards, it's still very low. The graph on the right, that is the month-to-month change in jobs added over the past 2 years. Despite monthly variation, we would say that jobs are still being added at a relatively comfortable rate. So how can jobs continue to grow while the unemployment rate goes up? Well, simply put, the amount of people that have entered the workforce has increased. And this has primarily been due to immigration. So that has been a very helpful. It's thought that immigration has helped kind of buoy the economy, as we saw in 2021 and 2022 with that heightened inflation, when a lot of economists and investors were expecting a recession. The labor market was really a positive through all that. It will be interesting to see, given the current administration's stance on immigration, and how it's going to affect the total labor market moving forward. I think to see some hard material impact on the total labor market, more funds will have to be allocated there, which would include probably some congressional action. There is a majority in Congress, in the White House right now for the Republican Party. Not saying it could happen, or not saying it wouldn't happen, but there is a potential for immigration to be impacted that would in turn hurt the labor market. So again, the majority of the data is currently pointing to a relatively strong labor market, but there are some areas to keep an eye on. Alrighty, so this is the Fed funds rate. This is the rate which is controlled by the Federal Reserve. And the Federal Reserve sets interest rate policy. They set interest rate policy to meet its two mandates, which is maximum employment and price stability. So, for instance, if prices go up, the Federal Reserve would rise rates to make borrowing more expensive, which would dissuade consumers to spend money. So the demand for products would decrease. On the flip side of that, if unemployment goes up, they would likely lower rates to persuade consumers and businesses to borrow and spend, which would then boost the economy. So as you can see, if growth were to slow down, but prices remain high, the Fed is really put in a difficult position. So for example, prices go up, Fed raises rates to combat inflation. They run the risk of negatively affecting unemployment by way of slowing down the economy. Like many other investors, the Fed did announce the other day that they're currently in a wait and see mode, really waiting and seeing on how this tariff situation plays out before taking any sort of material monetary action.
Hey, Dan, real quick, I think
Yep.
one other interesting observation here is, we're showing you a 70-year chart of interest rates. And you'll notice from if you look on the right side here, coming out of the financial crisis, one of the ways that the Federal Reserve was able to help financial institutions get out of it was essentially cut interest rates down to zero. And that remained for quite some time because it took a long time to recover from what happened during that 2008, 2009 recession. As the economy started to recover, the Federal Reserve was slowly able to raise interest rates to a more reasonable extent. And you see here, but leading up to COVID, they had to cut it back to zero again to try to stimulate the economy again. So we're not there anymore. The zero interest rates are not here today. They are, if you look at long-term history, they're pretty unprecedented. So I think if we take a step back and we think about it, zero interest rates probably were an anomaly during that time. It's very unlikely that they will happen again without things getting really, really bad. And with kind of inflation being stickier and potential, onshoring of some things and, tariffs and all of that, I have a hard time seeing interest rates go back to zero. So I know we got used to it for quite some time, thinking that money is essentially free. But when you take a big step back, that's not the case in most of history and is probably unlikely to happen again without some major event.
Appreciate it, Brian. The next slide looks at Doge. So I think Doge is worth discussing as it's been a headline mover and hot topic since Trump took office. Just so we're on the same page, the goal of Doge is to reduce what is deemed as wasteful government spending or improving government efficiency. Historically, improving government efficiency is something that's not new. Improvements were made in the 70s under the Nixon administration. The Clinton administration actually did it very well, working with both parties to actually achieve a budget surplus. And the economy was very strong during his time as president. So the takeaway is that this isn't something new and has been tried by both political parties. Direct to Doge, from what we know today, the impact from this program has been somewhat underwhelming, in our opinion, relative to what was initially expected. So if you see that graph in front of you, we've been asked quite a bit about government layoffs and how it will affect the labor market. As you can see, the federal workers make up about 2% of the total workforce. So a portion of that getting laid off is likely not going to move the needle much. As for government spending, Doge claims they've cut or saved about 160 billion so far, which isn't nothing, but it's far less than the 2 trillion initially expected. These cuts are really a tiny amount, less than 3%, I believe, of the federal budget deficit. So unless fraud is found in major programs such as military spending, Social Security, Medicare, which to the best of my knowledge, they haven't been touched yet or been touched at all, then Doge's effectiveness will likely be limited. It's interesting to note, yesterday during Tesla's earning call, Elon Musk announced that he will be spending significantly less time focusing on Doge and more on Tesla and driverless cars and AI and who knows what. But it'll be interesting to see how Doge is affected by his departure when he steps away and seeing how that unfolds moving forward.
And one other thing that I'll add regarding Doge is I think there's a realization that the effort has uncovered a decent amount of wasteful spending, some level of fraud. The reality is we are just spending way more than that we're bringing in, and it's pretty unsustainable at the government level. So in the attempt to cut everything, you're first going to look for fraud, then you're going to look for inefficiencies. And even though that they've been identified, to actually pull it back has been much more difficult than I think a lot of people imagined. It's really easy to spend a dollar, but taking a dollar away from someone impacts them, and that person or entity is going to fight pretty hard to keep it. So that's been a big constraint. So I think they've identified a lot of areas that they would cut, but actually implementing it is very difficult. Number one, from a legal perspective. Number two, it just creates a lot of issues for all the people that it ultimately affects. I think another important component here is that impact that spending reduction at the federal level will have. So there are some analyses out there that show that 50% of our GDP comes from government spending or something related to government spending, whether that's a worker at the federal level getting their paycheck, whether that's an entity that is creating jobs and creating economic activity, or an entity that's reliant on federal grants. 50% of our GDP comes from that. So Dan mentioned the number 150 billion in cut. I think the rough math is about 300 billion in cuts, all else equal, amounts to about 1% of GDP. So 150 billion has amounted to about 0.5% of GDP, all else equal. Now, eventually that saved money would make its way back into the economy in the form of the private sector, theoretically, but it doesn't happen immediately. And there is going to be a bit of a drag if this actually continues to do more in terms of cuts. But I think, as Dan mentioned, those major programs, Medicare, Medicaid, military spending, and Social Security, those are the big levers. Those are largely off limits. So I think the ultimate effects will be somewhat limited.
Okay, thanks, Brian. So the next slide here is on geopolitics. Geopolitics, they can be complex, very complex, but it's important to understand what's going on overseas, as these types of conflicts could potentially impact our economy. There are always conflicts globally, but we've highlighted a few, as you see before you. I think the important one that we've kind of looked at in depth is that Taiwan and South China Sea. Not trying to downplay the other ones; those are very serious and unfortunate situations in and of itself. But the Taiwan and South China Sea one, it's not a physical conflict, but it's a conflict that is very important to U.S. interest. Semiconductors have become a main component of a lot of our products: cars, computers, phones, the rise of AI, and Taiwan produces about 60% of the world's semiconductors. So if China were to escalate, you can see how this becomes a national security issue. So a big part of Trump's trade push is to diversify U.S. supply chains. So, becoming less reliant on Taiwan. But we do think that this is a big component of potential risk if this were to escalate. I think ultimately, I think there's a general consensus among U.S. citizens that they don't want the U.S. to be involved in wars or have their tax dollars spent on funding wars. So given the public's opinion, as well as potential global economic implications of these conflicts, it's really in America's best interest that these get resolved. And my hope is that it is the direction of the current administration that they do take meaningful steps to do their best to resolve these conflicts that you see before you.
Real quick, Dan, I think you hit on an important point that I think is worth expanding on. So, Taiwan is a good example of what is often termed potential single points of failure in a supply chain. So semiconductors are more important than ever in our economy. They go into everything that we do. I remember trying to buy a car coming out of COVID, and I got a small discount, or I was offered a small discount because they didn't have semiconductors for the automatic seats. So it would have to be manual seats moving back and forth. So they go into everything, even things that you don't think of. Given how critical they are, I think it's between South Korea in Samsung and Taiwan Semiconductor, over 85% of our semiconductors come from those two sources. And Taiwan, being so reliant on such a critical component, is a single point of failure in a supply chain that will have repercussions across the board. So I think it's extremely important that we start to look at the supply chain. And I think COVID was a big wake-up call that we need to diversify our supply chain. It needs to be a little bit better in terms of managing the risk around these single points of failure. And for things like semiconductor, rare earth minerals, things that are very critical to defense spending, anything that would go into manufacturing things for our military needs to be diversified, and we need to look through all of that. We can't necessarily rely on the supply chains that we had in the past, knowing that they can be disrupted pretty easily. Taiwan is a very good example of that. And with the tensions with China and with China's view on Taiwan, our reliance on Taiwan, hopefully, eventually there is some trade deal between us and China that has something here to help mitigate that risk. And then over the long term, hopefully we can onshore some semiconductor production or potentially diversify it, or a little bit of both.
I think Arizona's making a contribution to that with TSMC here.
Yep, exactly. Exactly.
All right. So the last item I'm going to touch upon before turning it over to Brian looks at consumer sentiment. And this is how consumers are feeling about their economic prospects. And as you can see, it's currently not favorable. The index is really around its lowest point in 40 years and right around the level of when we were in a global pandemic. If you look back, through coming out of the great financial crisis in 2008, 2009, all the way up until about until COVID, we were, as Brian mentioned, in this low interest rate environment. Inflation was extremely low. The stock market was going up. The price of people's homes, real estate was going up. So people felt rich, and that translated into a strong sentiment in regards to the economy. Over the last couple of years, sentiment has really been stagnant, even trending downwards. And this was really due to the rise of inflation and wages having a difficult time keeping up with inflation. So, I mean, people, paying your bills obviously is a big part of people's lives, and it's obviously very, very meaningful. I think.
Dan,
Yep.
quick question. Explain. I'm assuming, looking at this consumer sentiment illustration, that 50.8 is not good. That you'd rather have them over there in the June of 02, 04 at 110 or whatever it is. Is that right? And is
That's
50.8 coming down or is it going up?
So that is the most recent meeting. That is reading, I'm sorry, and that is going down. So if
Down is
you
bad.
Down is bad. Down
Okay,
is
just
bad.
wanted to make sure.
Right. No, down is bad. And why, sentiment is important to look at is because, these low readings can translate eventually into lower consumer spending, which would obviously negatively affect economic growth. So, if consumer sentiment is low, consumers believe that the economy is bad, they stop spending. Bottom line. Eventually that becomes a reality. It kind of snowballs, and then the economy really does slow down because people really feel like the economy is bad, and then it goes into recession. Now I'll say it's really to be determined if this low reading will translate to the actual economy. As I showed you before with for instance, like the labor market. The labor market as of now looks relatively strong. But with that said, the current outlook among consumers, it is pretty negative. Is
Two
that,
things.
is that,
Sorry,
Go
go
ahead,
ahead.
Brian. No,
Just
go ahead, Brian.
another couple of things I'd add to that. And to add a little context to why Dan is stressing the importance of consumer sentiment, consumer behavior, is that consumer spending is 70% of our economy. So if the consumer stops spending or even reduces spending marginally, is going to have a very significant impact. So that's why we watch this very closely. Again, attitudes about spending will dictate your behavior at some point, but it can be erratic. Another interesting observation, I don't think it necessarily changes how bad a 50.8 is, but if you were to measure this around party lines, it's a bigger divergence than we've ever seen, meaning that Republicans are probably more around 80 and Democrats are around 20 on this reading. So half of the country thinks the world is ending, and half of it thinks it's okay and it'll be fine. It still translates to 50.8, and a dollar is a dollar regardless of party lines. But it's an interesting observation of just how polarized consumers are and how that ultimately just translates to how they think about the world.
Okay. All right. I'm going to turn it over to Brian now, and he's going to touch upon the impact on markets, industries, and businesses. So, Brian, whenever you're ready.
Thanks, Dan. Yeah, if we go to page 11, so we put together a few slides more specific to the construction industry to kind of start to look at some of the impacts. So Dan talked about the economy at a broad level, major buckets of inflation, broad labor market, so on and so forth. And if we just double click a little bit and look at the construction industry, we can take a look at some of those same metrics and see how it may be different or similar to the broader economy. So this one is looking at prices for building materials and supply dealers. This is on the producer component. So this is looked at as maybe a little bit of a leading indicator, but you can generally interpret this chart as just the price inflation for building materials and supply dealers. As it stands today, it's pretty similar to the broader inflation number, somewhere around 2.5%, 3%, as you can see there kind of on the right-hand side. If you look back, I'm sure you're all familiar, during COVID, we had a massive spike in prices. That was due to supply chain issues and a lot of single points of failure, whether it's lumber from Canada or copper from Chile or whatever it is. Huge demand. And the demand increase is a lot of things needed to get built, but then a massive supply shortage. So you saw that here on the right-hand side, and then that came crashing down as supply chains started to normalize. You even kind of in the middle of this chart had a deflationary period as some of those absurd prices kind of came back to normal. Today, it's tracking more consistent with broader inflation. I think the big question, though, is, again, tariffs, just like it is for broader inflation. But for construction, it's going to be more specific to what the material is and how much of it we import from a specific country. So if we strike a great deal with Canada, that's going to have a positive effect on prices for lumber. If we strike a negative deal with Chile, for example, that's going to have an upwards pressure on prices for something like copper. But we also import a decent amount of copper from Canada. So it's all going to be very specific to, again, the material and which country we strike what deals with. If you go to the next page, looking at the labor market, specifically in the construction industry, the left-hand side is that unemployment chart, similar to what Dan showed you earlier. Overall, it generally tracks the same as overall unemployment. You're going to see more peaks and valleys due to seasonality, but they all kind of net out to that same general number. During COVID was a more dramatic spike in the broader labor market because a lot of construction and projects stopped during that time due to all the uncertainty. A lot of services, on the other hand, did have to stay in place, considered essential services and all of that. So that's why the broader number is more muted in terms of that spike. The construction did recover pretty well there. And as you can see today, it's pretty much at those normal levels, slightly a little bit higher and just north of 5%. And then if you look on the right-hand side, that's the month by month change in construction jobs. It's generally tracking the same, still pretty much positive numbers almost every month throughout the last 3 years. We go to the next page. This is what is considered more of a forward-looking indicator. So this, Dan covered consumer sentiment. This is construction industry sentiment. And what you'll see here are two different scores. One is the Consumer Sentiment Index. This is a broad sentiment survey across CEOs in the construction industry and how they think about their general outlook going forward. Current Design Index score is just the sentiment around the design phase. And design being the first phase within construction is oftentimes, this is seen as a little bit more of a leading indicator. I will note that the numbers here produced as of 3/31, but the survey was in February, so this was before a lot of the tariff issues took place. But you'll see that generally speaking, construction sentiment here has held up generally a little bit better than consumer sentiment. It's also a bit less volatile than consumer sentiment. Consumers tend to be impacted very emotionally about what may be going on in politics or something that's going on, elsewhere. Consumers tend to be more volatile. Construction tends to be more based on fundamentals in an economy, and they tend to have more of a longer term outlook. I think also there are, at least here in the US, many reasons to be more optimistic about construction prospects going forward. Naturally in the US, we have somewhere between 4 and 8 million, we're about 4 to 8 million houses short relative to what is actually needed out there. The estimates range quite a bit, but we have a housing shortage here. We have aging infrastructure. A lot of it is going to require attention, repurposing, and potentially just complete reconstruction. There is going to be a massive energy build out, whether it's green energy or fossil fuels, because between artificial intelligence, increased use of blockchain, and potentially the onshoring of more manufacturing, we are short on our own energy production. And it is going to be important to build out more energy infrastructure, potentially newer energy infrastructure that's more efficient to meet that demand. Our expectations for energy consumption here in the US is set to double over the next 10 years. And our facilities are going to need to keep up with that. And then again, if there is onshoring, we got to rebuild these plants or construct them from scratch. We don't have much manufacturing capability here in the US. That has been hollowed out over the last 20 years. And if any of that starts to reverse, that's going to be positive for construction as well. So overall, there's a lot of reasons to be optimistic about the outlook for construction, and there's going to be kind of structural tailwinds going forward overall. If we go to the next page, this is taking a little bit of a higher level look. This is small business sentiment. So similar to consumer sentiment, construction sentiment, this is just small businesses as a whole. And what you'll see here is that sentiment can be a bit volatile. It obviously fell off on the left side here during 2008. There was a bit of a decline here in 2020. Most recently, you're seeing a huge spike up. That was after Trump's election victory. And the idea there was you're going to have an administration that is focused on more business-friendly policies, namely around deregulation. And they certainly have held up there. There is a focus on deregulation. I think a lot of people can agree, at least in some way, shape, or form, there's too much bureaucracy in terms of getting things approved, processes on top of processes, so on and so forth. Paring some of that back will allow things to get done. I have a friend out here in California that got their house. They added an extension in their house, and the permitting took over a year. It doesn't make any sense. It took twice as long as the construction itself. So examples of that are good for small businesses if you start to pare back some of that regulation. You're seeing a dip there, though, and current small business sentiment is down to 97.4, so kind of giving up half of that gain. and that's concern around tariffs. Small businesses, just like any other one, any other business, imports, and if things cost more, there is going to be a concern. When you look at tariffs, they are a direct tax on an imported product. So when something comes in, an importer pays that additional tax collected by the government. Once it comes in, it does one of two things. Either that price increase gets passed on to the consumer, so we pay more for the same product, or that company producing it takes a smaller margin. Chances are it's going to be a little bit of both. But that's why you're seeing issues in the equity market. You're seeing concerns around consumers because somebody's got to eat that cost, and it's going to be a combination of businesses and consumers. So you're seeing a bit of a hit here. But net, small businesses do feel like they're in a bit of a better place, at least as of right now, than before the election results. Going on to the next page, if we look at the stock market, this is how it's been performing for the year. I know there's a lot of different colors and squiggly lines here. The takeaway here, though, is if you look at the S&P 500, which is that red line, all the way on the right-hand side, it's the lowest red line. Everything else here are different international markets, whether it's Germany, Japan, Eurozone, so on and so forth. They have all performed better. There's a couple reasons for that. Leading into this year, the US has just performed so much better than other markets. It is just easier for other markets to bounce more. The bar is higher for US markets. The second component, and you can see where that red line really started to fall off, is the implementation of these tariffs. I think there is a dissatisfaction with how erratic some of this rollout of tariffs have been. There's been some concern about the growth in the US. And if these tariffs are universal across the board with every country, the only common denominator is the US. All these other countries have relationships with the US, but it's not tariffs with each other. It's all with the US. So net, when you think about all of that, the US is going to be most affected because the US is the one implementing all of these tariffs. The third component there is a decline in the US dollar. So when you invest internationally, you invest in a foreign currency and you convert it back to dollars to calculate your return. If your dollar is weaker, then it's going to convert back to less dollars. Therefore, or if it's stronger, it's going to convert back to less dollars, giving you smaller return. If it's weaker, it's going to give you a better return. So the US dollar has declined recently, meaning an international investment is yielding an additional return when you look at it in US dollars. You can see that on the next page. The US dollar is extremely important. It's the global safe haven currency, even though that's starting to be questioned a little bit now. And it's used to trade a lot of global goods. So when you buy and sell oil, for example, everything needs to be converted into dollars before you purchase any barrel of oil. So it is the most important currency in the world. And you can see this is a 45-year chart of the dollar. It goes up and down for sustained periods of time. And you can see recently, since 2016, it has been pretty much on a straight upwards trajectory. If you notice the little triangle, though, it has pulled back quite significantly. We're at 113 today on this index of 120. So a decline of roughly 6%. That was literally just in the last month or so. That is great for international investments. It's not good if you're traveling abroad because your dollar is not going to go as far. But this is certainly something to watch. And I think between the tariffs, the implications for slowing growth in the US, and just the erratic policy that's been rolled out so far, there's been less of an appetite for US assets and therefore hitting the US dollar. So is this part of a longer trend lower, or is this just kind of a hiccup in the same upwards trend? I think that's going to be determined based on what happens with these negotiations over just the next few months. This one here, fixed income, what we're looking at here is a US 10-year Treasury yield. So the US Treasury issues bonds. They're of all various maturities. Some can mature in 90 days, some can mature as long as 30 years, and everything in between. We're picking a 10-year bond here because the 10-year bond is what a lot of consumer loans are based on. So if you think about mortgages, for example, it's going to be largely based on the movement of this 10-year. The way the 10-year yield moves over time, your mortgage rate is probably going to move roughly in line with that. It's generally been around this high 4 to low 4 range throughout the year. It has picked up a little bit here lately, and there is speculation for that. So if we look at kind of Liberation Day till now, there's been some erratic activity. So if you look at that first decline right around April, that was in the beginning of the rollout of this tariffs. Equity markets sold off. There was a flight to safety, right? So when people panic, they will buy US Treasuries generally because that is the safer asset. So when money goes into bonds, you'll see yields come down. That happened, and then all of a sudden there was a big spike in yields, which is very confusing. There's a lot of theories out there to what it generally means. But I think some of that is that the Fed is now caught in a tough spot, as Dan articulated earlier, and they may have less ability to lower interest rates in the future, and that may be reflected here in the 10-year. So I know that's a bit technical, but I think the general takeaway here is that there's good reason to expect kind of these higher rates where we're at today for a bit longer, whether it's because of inflation, potential tariffs, so on and so forth. So that is the end of kind of how it's impacting asset classes, the construction industry, kind of small businesses, consumers, and all of that. I'm going to turn it over to Dan now, and he's going to talk a little bit about kind of what we see next in different scenarios.
All right. Thanks, Brian. Okay, so the next 3 slides, as Brian alluded to, they really summarize our base, worst, and best case outcomes. I mean, these are broad outcomes that we can see playing out depending on on multiple factors. So the first is our base case. We assigned a 60% probability to this one of playing out, but in our base case, and the best way to summarize it is that global trade is reshaped, but the economies and markets either begin to adapt and businesses continue with modest disruption. So essentially a combination of somewhat quick adoption and maybe things reverting back to normal. Within this, a variety of trade deals are reached with various trading partners in different shapes and rates. That would include our major trading partners, Canada, Mexico, China. Within that, the expectation is that some retaliatory tariffs are in place. The hope is that most are selective with the possibility of further negotiations in the future. But there is some sort of retaliatory tariffs. Businesses are very important to this outlook, to if the economy will be able to sustain these tariffs. We need businesses to continue to invest, to continue to build up projects so people can stay employed, get paid, pay their bills. So in this scenario, we do see businesses continuing to invest, albeit somewhat slowly, given the continued uncertainty around trade, and that checks out, right? I mean, businesses aren't just going to throw a bunch of money into the economy if there's just heightened uncertainty. As for the markets, we do think with that uncertainty, with the variety of deals, market volatility could remain high in the near term, but eventually subside as maybe more agreements are reached or as investors adapt to the new environment. So, and then the last is onshoring. We start to see some sort of onshoring of specific industries, namely critical minerals, chips, energy, defense, anything related to national security. We start to see that being produced onshore. So that is the big summary of our base case, which we do see playing out. The next is our worst case. To summarize the worst case, everything that is threatened actually materializes. And the effect of that is a ton of things. Tariffs with a lot of countries, essentially a trade war. That causes inflation to move much higher. Supply chains are affected. Countries look elsewhere to source products, but that takes time, so product shortages occur. Businesses halt investments. Global markets continue to draw down, and policy uncertainty continues. So that is the worst case scenario. Not to end on a bad note, this is our best case. So best case is really the complete opposite. But to summarize this one, what's been done in terms of tariffs have largely get rolled back and things go back to normal or business as usual. I think another way, interesting way to look at this outcome, if you think back to the election, the markets were trading near its highs and pricing in strong economic growth. So maybe another way of looking at this best case scenario, or for it to come to fruition, is that the attitude towards Trump and the economy he was campaigning for in November becomes a reality. I know that's a lot, but it's another interesting way to look at it. I'll note, and it's reasonable to assume that every day that goes by, the probability of this outcome becomes smaller because tariffs are happening now. But as I mentioned in the beginning, these things are fluid. We received some better than expected news today in terms of uh, Trump's perspective on trade negotiation deals with China. Him softening his stance there. The market like that. That probably boosts not only our base case but our best case as well. I think ultimately there are a broad range of potential outcomes here. Given the uncertainty around trade. But as trade negotiations progress and deals start getting announced, we should be able to see a clear path for the economy. So it's tough to do now, but I think just waiting and seeing how these trade deals unfold is really the best bet for most. That's all we have for our presentation and prepared remarks.
Okay, I have a couple of general questions, but and they don't involve you going back to your slide. So if you can go ahead and unshare,
Mhm.
that way I can see the cascade. There we go, perfect. And if anyone has any questions, I'll recognize them. I have a couple of them. What should contractors prepare for in 2025?
Yeah, so I can take that one. I think not to say that it's necessarily going to happen, but what to prepare for because it could happen is higher prices. And that is, even if the base case occurs, but we strike an unfavorable deal with a high tariff on a particular material that within whatever component of the construction industry uses a lot, then you're going to need to prepare for higher prices. So having some sort of contingency plan and understanding, how you would deal with those higher prices is important. Maybe there are a variety of sources for some of those materials and thinking about where potential tariffs could and couldn't impact it more. You may want to think about diversifying your supply chain, just like we're thinking about nationally. So I think that's one component of it. So that is kind of the pain to prepare for, but I think the optimistic thing to prepare for are some of the things that we articulated earlier, and that's I think there's a lot of reasons to think that there's going to be a lot of construction in this country for the foreseeable future, and there's just a ton of fundamental structural tailwinds. Again, that's energy infrastructure, that's broader infrastructure, kind of needing to be revamped. If there's any onshoring at all, that's going to require more construction, and then there's just this natural housing shortage. And just putting all of that together, I think there's just good, strong fundamental tailwinds, but there could be a hiccup because of some of these higher prices. So I think those are probably the things to focus on. And then I think maybe a third development kind of worth watching is based on those fundamental tailwinds. There's going to be different regions that are more or less benefited because of it, and kind of watching where those trends kind of take place may be worth it as well.
Okay, I had a litany of questions that you sort of answered with that specific response. No, it worked out great because you talked about tailwinds, you talked about what to look for in the economy, you talked about how there's potential impacts to construction, and those were sort of where I was going with giving the audience the opportunity to say, okay, what's that little crystal ball? And I say little because it's very, very difficult with the current volatility. So we will open it up to questions. If you have a question, just raise your hand and I will call on you, and then make sure you unmute your device. Any questions out there? Any questions? Come on, this is meant to be interactive. Come on, Kevin, Adam, you have to have a question. Nothing?
All right, David, I'll give you one.
All right.
The IIJA, the federal transportation legislation is, we kind of got that expiring on the horizon. And Congress does anticipate at least drafting bills this year. So for the construction industry's perspective, what do you see as far as the top priorities with the next transportation bill as far as providing some stability and confidence to the industry?
Um, I would have to look in that to that bill more to specifically answer your question. I do think that, regarding transportation in general, I think similar to the broader supply chain, I think there is going to be an effort to shore up that supply chain and maybe onshore some of the more critical components of that. What that ultimately looks like, I'm not sure. And I think some of that is the rationale for, the automotive tariffs and all of that that took place before Liberation Day. I think a lot of people forget about that. But those are very much happening, and I think there's going to be some different form of all of that. But I do think that it's going to be that general focus of kind of supply chain stability and looking at what's called single points of failure in there. But I'm not all that familiar with the bills, so I can't address your question too specifically.
Any follow-up on that, Dan? Nothing?
I have nothing.
Okay.
Brian, you have put it pretty well.
Any other questions? Okay. I just wanted to thank you, Dan and Brian, for participating. I hope that our membership got a good taste of what sort of this snapshot and where we are today with the economy. Um, let's just see how things go. Maybe in the next quarter, we'll have you guys back. I'll have you
Yeah,
guys back, and we can have another conversation, another touch point. Maybe just have an open forum, open dialogue about what's happening. But we're really grateful uh, for you participating, and for our members that are on the line. Our next event is the golf tournament, and that is completely sold out. And then on May 30th, we have our inaugural event honoring Mary Peters, which is the launch of our Women in Construction Awards. So if you folks want to get involved with the Women in Construction, our BWIC committee, we are ready and open for business. But May 30th is one of our events that we're going to have, and it's going to be a great one honoring Mary Peters. So
hey
thank you all.
Dave,
Yes, sir.
I just want to offer kind of three takeaways to kind of wrap this up. So
Sure.
if all of you don't remember anything Dan and I said, maybe you can kind of lean on this. I think there's kind of three components as I was listening to Dan talk and digesting all of this. So I think the first one is obvious. It's tariffs having huge impact, whether it's across consumers, whether it's across businesses, whether it's across asset classes. It's huge because it's a direct tax, and how this all pans out is going to have huge implications. And I think it already does, regardless of what ultimately pans out. So I think that's number one, that's true. Two is looking at some of the data, even though some of the sentiment may be less than ideal. I think overall we're still in a good spot in terms of our labor market, in terms of where inflation is, at least today. If inflation was at 4% and this was happening, I'd be much more concerned. So I think we're just generally in a good spot to withstand some of this. And the third one is just generally speaking, I think there's more reasons to be optimistic over the next 10 years than there is to be pessimistic. And this, just like everything else, all the turmoil, all the issues will pass. And being very pessimistic over the long term has never been the right base case. And I don't see the reason for it now. This is shorter term volatility. I know it can be a bit uncomfortable, and uncertainty is just clearly uncomfortable, but uncertainty goes in both directions. And I think we can certainly work through this, and we will. And, some of this just may create opportunity. So just, kind of be mindful of that and look for those opportunities as some of these issues may develop.
Well, it's interesting that you bring that up. I don't mean to monopolize. We'll be finished before the hour is up, but I sort of looked at consumer sentiment being down as an optimistic indicator. I know that sounds crazy, but sort of the rudimentary definition of inflation is too many dollars chasing too few goods, right? That's like the basic, all right? And my crazy mind went to, okay, if consumer sentiment is down, then you're probably going to have a situation where there's going to be less in the system, less dollars in the system chasing potentially more goods, which is actually better for inflation, right? Am I saying that right?
Yeah, no, I think that's exactly true. Weak consumer sentiment is a deflationary factor. It's just not good for economic growth. Economic growth is inflationary, all else equal. So those are kind of competing interests there. So, the Federal Reserve, when inflation's high and they try to bring it down, they raise interest rates and they're comfortable with the collateral damage, which is weakening the economy because it's deflationary. So you're exactly right, Dave.
And that's one of them that sort of was counterintuitive to me.
Yeah.
Anyway, whatever.
Yeah.
It's complicated.
Everything's about trade-offs. There's no answers to anything.
Right.
Trade-offs.
Any other questions before we close up? Any
I
other
do
final
got-
thoughts, Dan? Go
I
ahead.
do got one more, David. If you are interested in any of the material, we'd be happy to forward you the presentation. Just to note, most of the graph and data that we sourced came from articles or outlooks from our website. It is free. It's available, verisinvestments.com. Feel free to take a look. And if you have any questions, just let us know.
Yeah,
Thank you. Thank you, everybody. Have a fantastic day.
Thanks, everyone. Take care.
Thank you.
Bye-bye.
All right. Bye.
Bye.